Mathur here. I hope you all can hear me pretty clearly, and I am also hoping that you are able to see the first slide, which is titled "Welcome to Trading HD." So I hope you can see that. It's there on your screen, I hope. So let's get started. Before we start, I have to give you the disclaimer and a risk disclosure, and I have to read it out to you. The information contained within this presentation is intended for educational and illustrative purposes only and does not constitute investment advice. Do not make any investment decisions or other decisions based on the material presented. We cannot be held responsible for your trading results. For more information, please visit www.tradinghd.com. Okay, so I hope I'm not entirely new to some of you, and some of you were there for the previous webinar that we had about a month ago. That was the first webinar that we did under TradingHD's banner. And the idea of that webinar was to give you some early clues into the process that I believe works for professional investors, works for hedge funds, works for people who are sitting and trading in their barn offices. And this is something that I've been doing as a broker for the last 2 decades, servicing large hedge funds in all global markets, ranging from macro clients to single stock pickers all over the world. And part of my endeavor through this exercise with TradingHD is to share some of the techniques and some of the thrills that I've been able to get from the markets for the last 2 decades. So like always, it's critical that I emphasize that you always do your own work, and I can help you to try to create a process. And we go straight into the first big slide, which is talking about the S&P. Now, before we talk about the S&P, the one thing that I would like to say to everybody is that you must always look at the big picture of the market. I know some of you would be day traders, some of you would be short-term position traders in the market, but without a long-term understanding of what the trend of the market is, you will not make real money. That's my simple conclusion over the last 2 decades of watching markets. So I hope you can see this chart very clearly. What I'm showing you on this chart is a monthly closing price of the S&P 500. And what I have is the line in black, which is the closing price at the end of every month, going back to 1996. I've then got a red moving average on this, which is a 45-period exponential moving average. And then a blue line, which is the 200 simple moving average. And what I want to show you here is the interplay of these 2 moving averages, and to see that in the big picture, when price is above the red line, above the 45 period, we are in a bull market. Now, if you look at this phase in 99-2000, we were at a period where the RSI, which was, so this bottom panel is an RSI panel, a relative strength index panel. It's a 14-period RSI that has got 2 boundaries. The red line, which is 60, which many can consider to be overbought, and 40, which many of you can consider to be oversold. Now, many of you are used to using the RSI with a 70-30 time band. I like to use it from a 60-40 time band, and you can see why. When the RSI stays above 60, we're in a confirmed bull market. But when we break below 60, that's the first indication that the trend of the market could be changing. In the year 2000, we broke below 60, as the cursor shows you here. And then in 2007, early 2008, we broke below 60 again. Those were 2 very strong starts of bear markets, which were then followed with price breaking the 45 period exponential moving average, as you can see, and then staying beneath it. It was a very painful period that you could have avoided if you used a very simple process of using the 45 period. You look at it in 2008, the same thing happened. Once the RSI of 60 broke and we closed beneath the 45 period, we went into meltdown phase. Now let's try to apply this in the current market scenario. We have some sort of sideways movement now. Bear in mind that we bottomed in 2009 and we have rallied pretty much uninterrupted for about 75 to 80 months. That's a big, big rally. A rally without any big meaningful pullbacks in the middle. So this year, we've had a sideways market. So if you started if you started 2015, you had a price of roughly where we are right now, which is just under 2,100 on the S&P, and made no progress this year. This is to be expected after such a long, steady bull market. But notice what has happened. What has happened is that 60 broke with the big August decline that we had. We had the first break of 60 on the RSI, as you can see on the cursor. Now, this was an early indication that maybe the trend of the market is changing. But look, prices never broke below the 45 period, and we bounced all the way back up to here again. Study where the RSI is right now. We're ending towards the end of November right now. My contention is that we will spend a few more months going sideways. We could even retest the low. We could have a period where we have another little gush up, but not much higher from where we are right now, and we go sideways. And then we could set up the biggest bull market of a very long time. Let's look at the next time scale here. This is the weekly time period now. So rather than looking at the big picture, as I said, it's important to know what the big picture of the market is. We then start to zero in on slightly shorter term time frames, and we start with the weekly chart. You can see 2013 to 2014 was really a strong period for the market. The RSI barely came below 60 anytime. It was in an overbought zone. That's the sign of a strong, healthy market. And the first time it came to an of 40, it had pullback, which was the time to re-enter the market. But notice that throughout 2015, every weekly RSI failure came at a RSI reading of 60, which is almost always an indication that something was wrong with the market, and then we broke down. And look where we are right now. We're again at a reading of just under 60, and we are failing, as far as I can see, to break to the upside. So we have a sideways market at best right now. Let's look at the next slide. This is the daily price. So we've now come from a monthly to a weekly to a daily. You know, Stan Druckenmiller, who's someone who I really admire, always says, manage your money over the long term, but risk manage your money over the short term, which is to say, stay with the long-term trend of the market, but look at the short-term movements to figure out when you need to be out of the markets for short periods of time. So this was a really cool period, actually, where the market went sideways. It was a cool period to get out of the market because we had a sideways period that broke below the 45, below the 200. You could have easily escaped this entire decline had you followed the simple rule to get out of a market where price is below both the red and the blue line. It's really that simple. We then have a period where we've come all the way back to the highs again, and we don't really know whether we're going to make new highs here or whether we're going to go sideways. My contention is that this market does not have the energy yet to break to the upside. It needs to spend a few more months maybe going sideways within this sort of time period, time zone. We then look at the hourly chart of the S&P and see what is the hourly chart telling us. So we peaked just above 2100 in late October, early November. From there we had a sharp decline, and we are currently failing to make a new high. And you can see something that works across multiple time frames. I've shown you the same moving averages on a monthly chart. I've shown you the same moving averages on a weekly chart as well as a daily chart. Now I show it to you on an hourly chart. Look, we broke above both the red and the blue line in late September, early October. That was the start of another bull run. We've come back and we've rallied back above these two lines. My contention is that if we were to get a close beneath these two lines, we could get a retest of the low.